Okay, so you're thinking about investing, right? But man, it can feel like you're drowning in choices, like trying to pick from a menu a mile long.
Yeah, it's overwhelming, isn't it?
Totally. That's why we do this. Welcome to the deep dive, where we break down the stuff you want to know about. No need to sift through mountains of info yourself.
We do the heavy lifting.
Right, so you can get the good stuff without the headache. And today, we're diving deep into a classic, Common Sense on Mutual Funds, by the legendary John C. Bogle.
This book is considered a must-read by some of the biggest names in investing.
Yeah, folks like David Swensen from Yale, and even Nobel Prize winner Paul Samuelson was a fan.
What's interesting is what Samuelson said about Bogle's approach. He pointed out that while we can all admire Warren Buffett's incredible skill,
Yeah, Buffett's a genius, no doubt.
right, but most of us can't just copy what he does. Bogle, on the other hand, he lays out a path that anyone can follow.
That's about focusing on the things you can actually control, like keeping costs low and avoiding all that frantic trading.
Exactly. And that brings us to a key insight from Bogle. He saw the investment management industry itself, not just as a service, but as a business, a very profitable one.
Well, yeah, money makes the world go round.
Sure. And like any business, it's driven by that fundamental capitalist principle, seeking the highest returns possible. So what happens? In just a decade.
The industry explodes, right?
Yeah. The number of mutual funds more than doubles, jumps from about 2,700 to almost 7,000, and the number of managers skyrockets too.
From around 1,200 to nearly 6,000. That's crazy growth.
And it's interesting because this growth doesn't seem to follow the usual pattern we see in competitive markets. You'd think more competition would lead to lower prices, right?
Yeah, that's the whole creative destruction thing. Businesses fight for customers by offering better deals.
But in this industry, fees don't seem to go down like you'd expect. It's almost like a different set of rules apply.
So Bogle was this big optimist about long-term investing, but he had what he called a gloomy message about the mutual fund industry in particular. What was he so worried about?
Well, he saw some fundamental problems with the industry's structure, its operations, basically how it functioned, and how all that impacted investor returns.
Yeah, the actual results people were getting. And this all becomes even more important because we've seen this huge shift in how we save for retirement.
Right. It used to be about company pensions, but now...
It's all on you, isn't it? You got to figure out your own 401k, your IRA.
Yeah.
It's a lot more responsibility on the individual.
Exactly. And Bogle saw a couple of big problems with this shift. One, people simply aren't saving enough.
Yeah, putting enough away for the future.
Right. And two, it tends to be the higher earners who are actively saving and investing. He cites some data that shows a whopping 88% of the top 20% of income earners participate in those defined contribution plans.
And so that means a lot of folks are falling behind.
Definitely. So with all that in mind, Bogle's book really digs into some core themes that are super relevant for everyday investors like us. What are some of the big ideas he wanted to get across?
Well, there's this crucial distinction he makes between relative returns and absolute returns. I always get those mixed up.
It's a common mistake. Relative return is how your investments do compared to something like the S&P 500.
So are you beating the market or not?
Right, but absolute return is the real meat and potatoes.
The actual profit you're taking home.
Exactly. He also talks about how a fund can get too big, have too many assets.
Sounds counterintuitive. You want a fund to grow?
Well, Bogle argues that sometimes all that size can make it harder for a fund to keep generating strong returns. It's like a giant ship trying to make a quick turn. He also highlights a big issue that a lot of people overlook, the tax inefficiency of a lot of mutual funds.
Taxes. That's not something you usually think about when picking a fund.
True, but it can make a big difference in your overall returns. And then there's the factor that can be your best friend or worst enemy in investing.
Time.
Yeah, time heals all wounds, as they say.
Well, in investing, time can definitely be a powerful force the longer you're in the market, the more potential you have to grow your money.
Right, and also to ride out those inevitable ups and downs. But time can also magnify the negative impact of costs. Those little fees you pay every year, they can really add up over time.
Like compound interest, but in reverse.
Exactly. And Bogle noticed a trend that worried him. He felt the industry was shifting away from good, solid investment management.
And more towards just selling products.
Yeah. Marketing and sales were becoming the priority, and that's not always in the best interest of the investor.
So where did Bogle see the root of the problem in the fund world?
He pointed to how funds are typically governed, specifically the fact that many funds delegate the actual investment decisions.
To a separate management company.
Right, and Bogle argued that this creates a potential conflict of interest. What's good for the management company's bottom line?
Isn't always what's best for the people who own shares in the fund.
Exactly. So Bogle was a big proponent of simplicity and common sense in investing. And he even suggested some pretty fundamental changes to the industry. He really wanted to see things structured in a way that truly served the investor.
Now, one of the most fundamental questions for investors is how to split their money between stocks and bonds. What insights did Bogle offer about that?
Well, he dove deep into the history, going all the way back to the early 1800s.
Wow, that's a long view.
Yeah, he wasn't messing around. And he found that while the stock market has delivered great returns over the long haul.
Yeah, the long-term trend is up.
Right. But there's a lot of volatility along the way. He even shows us the numbers, the standard deviation of returns over different periods.
Standard deviation, that sounds a bit technical.
Think of it like measuring the ups and downs, the bumps in the road. Higher standard deviation means a bumpier ride, more risk.
So stocks are riskier than bonds in the short term.
Generally, yes. But over the long term, the picture changes. Historically, stocks have not only given higher returns,
But they've also been a better hedge against inflation.
right. Bogle cites the work of Jeremy Siegel, who's done a lot of research on this. So if you're looking to build wealth over decades,
Stocks have historically been the way to go.
right. But Bogle was also realistic. He knew there would be times when bonds might outperform stocks.
He called them those cold winters for the market.
Yeah, and he found that in about 1 out of every 5 10-year periods since the start of our markets.
Bonds actually did better than stocks.
Right. More often than you might think. But when you stretch the time horizon even further,
To 25 years, say?
right, then the odds of bonds beating stocks really shrink. It only happens about 1 out of every 21 periods. So bonds can be a good safety net when the market gets rough.
They help you ride out those storms.
But a balanced portfolio with both stocks and bonds is usually the smart move for most long-term investors.
Now, he also introduced this idea called the pie theory. Sounds delicious, but I'm guessing it's not about actual pie.
No, it's about understanding how market returns work in aggregate. Bogle said that the total return of the stock market.
So how much the market grows as a whole.
Yeah, he uses the example of about 11% annually, historically. That return is like a fixed size pie.
And all the investors in the market are sharing that pie.
Right. So if some investors are getting bigger slices,
Someone else has to be getting smaller slices.
exactly, that's the gross pie, before you even factor in all the costs that come with investing.
So some investors might think they're getting ahead by beating the market.
But really, they're just taking a bigger piece of the pie from someone else.
Now, here's something I've always found strange about investors. It seems like they often do the exact opposite of what logic would suggest.
Like what?
Well, when prices are already high, that's when everyone wants to buy in. But when prices drop...
People get scared and run for the hills.
Exactly. Did Bogle talk about this kind of investor behavior?
Oh, yeah. He saw it happen time and time again. After the big crash in '87, investors panicked and sold.
Then, as soon as the market started going back up,
They piled back in, even more enthusiastically. He uses the example of massive inflows into equity funds in the mid-90s.
so it's like people are more worried about missing out on gains than they are about losing money.
Right. And Bogle was really critical of this short-term thinking, this constant buying and selling.
What he called turnover.
Yeah, he felt it showed a lack of understanding about how long-term investing actually works.
Because you can't really build wealth by chasing the latest hot stock. Right?
No, Bogle made it clear that long-term returns in the stock market.
They come from the earnings of companies and from the dividends they pay out.
Exactly. For bonds, it's the interest payments. All that frantic trading doesn't create real wealth, it just shifts it around.
So the key is to focus on the fundamentals.
Exactly. Now, Bogle also had this interesting way of looking at long-term market returns. He called it applying Occam's razor.
Occam's razor. Now, I'm not a philosophy major, but I think I've heard of that.
It's this idea that the simplest explanation is usually the best. So, Bogle applied this to the stock market and said that long-term returns are mainly driven by 3 factors: dividend yield, earnings growth.
And changes in the price-to-earnings ratio, the PE ratio.
Right. He argued that if you understand these 3 things,
You can get a pretty good idea of what future returns might look like.
yeah, without getting caught up in all the noise and speculation. The dividend yield, you know that right away. Earnings growth, that's harder to predict. but it has some historical patterns.
And then there's the PE ratio, which is all about how much investors are willing to pay for a dollar of earnings.
Right, and that one's the most speculative of the three. It can swing wildly in the short term.
So could you give us a quick example of how this Occam's razor calculation might work?
Sure. Imagine the market has a dividend yield of, let's say, 3%, and you think corporate earnings will grow at an average of 7% a year over the next 10 years.
So that's already a 10% return.
Right. But then, let's say you also think the PE ratio will expand a bit, maybe from 15 times earnings to 18 times earnings. That could add another 2 percentage points to your return.
Bring it up to 12% annually.
Yeah. So it's a way of breaking down those complex market returns into more understandable chunks.
Simple arithmetic, as Bogle put it. Now, he didn't just talk about this theoretically. He actually used it to analyze past returns.
And even to make predictions about the future, especially in the 1990s.
How did his predictions turn out?
Well, at first they were pretty much in line with historical averages, but then things got a little crazy in the late 90s.
The dot-com bubble.
Right. Stock returns went through the roof, way beyond what anyone expected. Even Bogle admitted that his predictions had been way too conservative.
So even the most sensible models can be thrown off by periods of irrational exuberance.
Exactly. And, he applied the same Occam's razor thinking to bonds as well.
So he thought bond returns were mainly driven by their starting yield, the interest rate they're paying when you buy them.
Right. And unlike stocks, there's not as much potential for bonds to go up in price.
So you're mostly relying on that steady stream of interest payments.
Exactly. Now, when it came to putting it all together, deciding how much to invest in stocks versus bonds,
What was Bogle's advice?
he was a big believer in having both stocks and bonds in your portfolio. He even showed the historical data for different asset allocations.
Different mixes of stocks and bonds.
Yeah. And what's really interesting is that over the long term,
The returns for different allocations were pretty similar.
they were. It shows how diversification can really smooth out your ride, especially if you're in it for the long haul.
So having a mix of both helps you weather those market storms.
Exactly. And Bogle said a good rule of thumb for your asset allocation is to consider your age and your overall wealth.
So as you get closer to retirement.
You gradually shift more towards bonds, the less risky asset.
Now, we've talked a lot about the potential rewards of investing. But we can't ignore the elephant in the room. Costs. Bogle was adamant about this, wasn't he?
Oh, yeah. He was passionate about keeping costs low. He showed how even those seemingly small fees
Can really eat away at your returns over time.
Exactly. He presented tons of data comparing actively managed funds to index funds. And guess what?
Index funds consistently came out on top.
They did. And it's mainly because of those lower costs. He even had this interesting way of thinking about costs, what he called the fourth perspective.
Intriguing. What was that all about?
Well, there's this thing called the equity risk premium.
Yeah, the extra return you expect to get from stocks because they're riskier than bonds.
Right. So Bogle's point was that if your costs are too high, they can completely wipe out that risk premium,
So you're taking all that extra risk for nothing.
essentially. And he emphasized that the average expense ratio you often see quoted for funds,
Around 1.5%.
yeah, that often doesn't tell the whole story. There are all these hidden costs, like the fees from buying and selling securities within the fund.
And any upfront sales charges, those loads.
Exactly. So your actual costs could be way higher, maybe even 2.5% or more.
And when you're paying that much, a huge chunk of your potential returns is going straight to fees.
Right. It's like working your tail off and then giving away half your paycheck.
So keeping costs low is absolutely essential. And that leads us to one of Bogle's most famous ideas, the power of indexing.
Yeah, he was a huge proponent of that. He showed how a simple index fund, like one tracking the total U.S. stock market,
The Wilshire 5000.
yeah, that consistently outperformed the average actively managed fund over long periods by a significant margin, too.
Something like 2.5 percentage points per year, right?
Right. And it all comes back to those lower costs.
Yeah.
When you compound those savings over 15 years, it's a huge difference. More than double your initial investment.
So index funds are basically capturing most of the market's return.
Without all the extra fees and expenses.
Now, I know some people feel like they need a financial advisor to help them navigate all this.
Yeah, and Bogle acknowledged that good advisors can be helpful.
They can help you plan, set up your asset allocation, and all that.
Right. But he was also skeptical about their ability to consistently pick winning funds.
To find those managers who can actually beat the market year after year.
Yeah. He just didn't think it was possible consistently.
And he even used a real-world example of a fund that started out hot but then stumbled as it got bigger.
The Pilgrim Baxter Growth Fund, they had incredible success early on.
But then tons of money poured in.
And their performance tanked.
So the bigger they got, the harder it was to keep those returns up.
Exactly. It's a classic example of how nothing fails like success, as Bogle put it.
So Bogle's message is loud and clear. Embrace simplicity, keep costs low, and consider the power of indexing. He really believed in the S&P 500 index as the core building block for most investors.
Yeah, he was all about that. He even showed the numbers comparing the S&P 500 to actively managed funds over different time periods, and the index won almost every time.
Now, the S&P 500 is mostly made up of large companies, right? Large cap stocks.
Yeah, it represents a big chunk of the overall market.
So how did Bogle think about the size of companies' market capitalization in relation to indexing?
Well, he pointed out that the U.S. stock market is heavily tilted towards large-cap stocks. Something like 75% of the total market value comes from those big companies.
Mid-cap stocks make up about 15%.
And small caps are the remaining 10%. But here's the thing, the number of mutual funds out there.
There are way more funds focused on small and mid-cap stocks.
Yeah, so you have to be careful about comparing the S&P 500 to just any fund. You need to compare apples to apples.
Right. A large cap index shouldn't be judged against a small cap fund.
Exactly. And Bogle pointed out another interesting technical point. Index funds don't usually hold any cash.
Whereas actively managed funds often keep some cash on hand.
Right. And in a really hot market, that cash can drag down the returns of an index fund a bit. But Bogle also noted that we often see something called survivor bias in fund performance data.
Survivor bias.
Yeah, we're only looking at the funds that are still around, the ones that haven't crashed and burned. So the data might be skewed.
It's like looking at a group of marathon runners at the finish line.
And forgetting about all the people who dropped out along the way.
Exactly. And here's a really interesting thing Bogle found. When you look at mutual fund returns before any expenses,
Almost half of them actually outperform the Wilshire 5000 index.
so on a gross return basis, active managers aren't doing so bad.
It's those pesky fees that eat away at their returns.
So indexing isn't just about being lazy or giving up. It's a way to keep more of what you earn.
Absolutely. Now, indexing has come a long way since Bogle's early days. And with the rise of ETFs, the landscape has really changed. What did he think about those?
Yeah, exchange-traded funds are everywhere now.
He definitely acknowledged their popularity. They've grown like crazy. But he also had some concerns. He saw them as a bit of a departure from the core principles of classic indexing.
So what were the issues he saw with ETFs?
Well, for one, many ETFs are very narrowly focused.
Like on a specific sector or industry?
Right. So they don't offer that same broad diversification you get with a traditional index fund. And because ETFs trade throughout the day,
People tend to buy and sell them more often.
which can be a recipe for disaster.
They get caught up in the short-term noise and end up hurting their own returns.
Exactly. And lastly, Bogle noticed that the fees on some ETFs, especially the more exotic ones,
They can actually be higher than traditional index funds.
so they might not be as cost-effective as they seem.
Okay, so ETFs are a tool,
Mhm.
but they can be misused. Now, within the world of stocks, there are all these different investment styles.
Mhm.
Value, growth, blend.
And different market caps, too. Large cap, mid cap, small cap.
Right. So how did Bogle recommend navigating all that?
He said for most investors, the core of their portfolio should be a diversified large cap blend fund.
One that doesn't specifically tilt towards value or growth stocks.
Right. And he said the big decision is whether to go with an actively managed fund or an index fund.
So even if you think value stocks are going to do well,
You can still find a low-cost index fund that tracks that style.
makes sense. Now, I know there are rating systems for funds, like Morningstar. Did Bogle think those were helpful?
He said they could give you a general idea of how funds have performed in the past.
But the real difference between funds is often in their risk level.
Right. He showed how the volatility of returns, what's called standard deviation, can vary a lot between categories like large cap value and small cap growth. And when you look at risk-adjusted returns, using something like the Sharpe ratio,
Index funds come out ahead most of the time.
they do. It's about getting the most bang for your buck, taking on the least risk for the return you're getting.
Now, a lot of investors dream of beating the market. But what are the odds of actually doing that consistently? Bogle had a pretty clever way of framing this, didn't he?
He did.
Yeah.
He compared it to Pascal's wager, that philosophical argument about whether or not to believe in God.
I'm curious how he connected those two things.
Well, his point was that if you believe the market is efficient.
Meaning prices already reflect all the available information.
Right. Then the smart move is to just go with index funds. You'll get a decent return and you'll be diversified.
So heads, you win.
Right. But if you try to beat the market and you fail,
Which, statistically speaking, is more likely to happen.
right, then you'll probably end up underperforming and paying higher fees for the privilege. So, tails, you lose.
Heads, you win a decent return. Tails, you don't lose as badly. Sounds like good odds to me.
Exactly. And Bogle presented all this data showing how actively managed funds performed against the S&P 500 over 25 years. And in most cases,
The index fund came out on top.
by a long shot. He even showed how a hypothetical $10,000 investment would grow way more in an index fund.
So trying to outsmart the market, it's a tough game to win. Now, we've focused a lot on stocks, but what about bonds? What were Bogle's thoughts on those?
He saw the bond fund industry as this kind of untold story. They had enjoyed some great returns.
Especially in the years leading up to when he wrote the book.
Right. But he was worried about the fees. He used this great analogy from Peter Lynch. You don't pay Yo-Yo Ma to play the radio.
Meaning you shouldn't pay high fees for something you can get for cheap.
Exactly. And he showed how even in the world of bonds,
Costs can make a huge difference.
yeah, he looked specifically at municipal bond funds and found that the funds with the highest fees.
They consistently had the lowest returns for investors.
Right. And it's the same story as with stock funds. The high-cost funds were usually the ones sold with commissions.
While the low-cost funds were mostly no-load funds.
Exactly. And Bogle made a simple but important point. Fee dollars are real money.
It's not like they just disappear. Someone's pocketing that money.
Right. He used the example of this giant GNMA fund that was charging huge fees.
Even though it wasn't even outperforming a basic index.
He included a table in the book showing how much of a bond fund's total return was being eaten up by expenses. And again,
Index funds were the clear winners.
yeah, they were far more cost-effective. And even though there are regulations meant to protect investors,
Bogle was worried that people weren't paying enough attention to those bond fund fees.
they were just assuming bonds were safe and ignoring the costs.
Now, a lot of people talk about investing globally. What was Bogle's take on international stocks?
He was a bit cautious on that front. He looked at the historical data, comparing U.S. stocks to international stocks.
And the results are pretty mixed.
They were. So he warned against assuming that adding international stocks would automatically lead to higher returns.
Because you're also taking on more risk, like currency fluctuations.
Right. And he specifically advised against trying to time the market in foreign countries.
Thinking you can buy low and sell high.
Exactly. He thought it was a fool's errand. And he had an interesting idea about how American investors could participate in the global economy.
Without having to go overseas.
Right. He pointed out that many of the big companies in the S&P 500,
Companies like Coca-Cola, Intel, Microsoft.
yeah, they get a huge chunk of their revenues from outside the U.S.
So by investing in those companies, you're already getting global exposure.
Exactly. The acres of diamonds might be right here at home.
Now, what about relying on those so-called experts? Financial advisors, newsletters.
You mean the folks who promise to beat the market for you?
Right. Did Bogle buy into that?
Not really. He looked at a bunch of studies on the performance of professional money managers.
And their track record wasn't that great.
It wasn't. He mentioned this study by William Sharpe, a really influential economist.
And Sharpe found that the average actively managed fund actually underperformed a simple mix of index funds.
Even before considering any sales charges.
And there's that Mark Carhart study, which showed that any persistence in fund performance
Was mostly explained by factors like investment style and expenses.
and survivor bias plays a role too, right?
Big time. We're only seeing the data for the funds that survived, not the ones that went belly up.
Bogle also cited a report by Morgan Stanley Dean Witter.
And they concluded that past performance was pretty much useless in predicting future success.
So just because a fund did well last year.
Doesn't mean they'll do well next year.
He also looked at the recommendations of some big-name investment gurus.
Yeah, he tracked their advice over a decade.
And on average, their portfolios ended up matching the S&P 500.
Not exactly beating the market. And very few of the newsletters he looked at actually managed to outperform.
So even the experts have a hard time consistently getting it right. Now, we've mentioned this idea that past performance doesn't guarantee future results, Bogle talked about this concept of reversion to the mean, right?
He did. It's the idea that things tend to even out over time.
Like a basketball player who has a hot streak
Eventually, they'll cool off.
and a team that's at the bottom of the standings.
They're bound to win a few games eventually.
So in investing, if a fund has been doing exceptionally well,
chances are they'll eventually come back down to earth.
and vice versa, a fund that's been struggling might turn things around.
Bogle showed this happening with funds in the 90s and 2000s. Top performers often regress to the average.
He also pointed out how different market segments tend to outperform in cycles. Growth versus value, U.S. versus international.
It's like a pendulum swinging back and forth.
He even compared it to Newton's third law. Every action has an equal and opposite reaction.
So, trying to chase the hot performer of the moment?
Is probably not a winning strategy in the long run.
Right. The key is to stay disciplined and stick to your plan.
Now, Bogle also talked about this phenomenon he called investment relativism. What was that all about?
Well, he noticed that the focus in the industry had shifted away from absolute returns.
The actual amount of money you're making.
Right. And towards relative performance.
How you're doing compared to some benchmark.
Exactly. And the big bogeyman was the S&P 500. Everyone was obsessed with beating that index.
So it's no longer about just making money. It's about keeping up with the Joneses.
Right. And Bogle thought this was a bad trend. It was pushing managers to take on more risk.
And focus on short-term gains at the expense of long-term value.
Yeah. He also criticized the overuse of all those fancy metrics like beta, alpha, and Sharpe ratio.
They were becoming more important.